Welcome to today's market report.
European stocks rose on Thursday as travel stocks snapped a 4-day losing streak after Ryanair lifted its long-term traffic forecast, offsetting concerns about China's slowing economy that dragged down miners. The Pan-European Stock 600 index climbed 0.4%, bouncing off a 6-week closing low hit in the previous session. Europe's largest low-cost carrier, Ryanair, jumped 7.9% after it raised its long-term traffic forecast. Revels, EasyJet, British Airways, owner IAG and Wizz Air gained between 3.9% and 7%. It's been a slightly better day for markets in Europe, shrugging off a weak Asia handoff, with some decent gains for travel and leisure, which has enjoyed a respite after Ryanair's announcement, according to CMC Markets UK. While Asian stocks came under pressure from concerns about China's economy and fallout from debt-ridden developer China Evergrande Group's financial troubles, European stocks were on a firm footing as strong US data reinforced optimism about a recovery in the world's largest economy. Miners including Rio Tinto, Anglo American and BHP Group were among the top drags as metal prices fell after China reiterated plans to release more metals from its reserves. German automotive supplier Continental AG fell 6.2% to the bottom of Stock 600 after the spin-off of its unit Vitesco. The utilities index was flat after a near 3% fall on Wednesday. Spain passed an emergency measure earlier this week to reduce energy bills, raising concerns over the hit to utilities profits. Spain's Endesa and Iberdrola extended losses for a third day to fall to their lowest since 2020. Italy is also looking to introduce short-term measures to offset the expected rise in retail power prices, a minister said on a radio interview. Stocks in the sector are suffering from the risks of regulatory intervention, as in Spain, and it will be necessary to see how other governments in Europe will intervene. Current prices do not reflect high energy and gas prices. Oil prices steadied on Thursday after hitting a multi-week high a day earlier as the threat to US Gulf crude production from Hurricane Nicholas receded. Brent crude ended the session up 0.3% at $75.67 per barrel. WTI ended the session unchanged at $72.61 per barrel. Gold futures were down 0.05% at $1,752.80 per ounce. On the FX front, the GBP/USD broke below 138 and tumbled to 137.63, reaching the lowest level since 9th of September. It remained near the lows under pressure amid a rally of greenback across the board. Economic data from the US released on Thursday came in above expectations, particularly the Fed and retail sales. Those numbers triggered a rally of the dollar and a sell-off in treasuries. The 10-year yield jumped to 1.35% before easing to 1.32%. Ahead of next week's FOMC meeting, the greenback rose versus all its rivals. Prior to the economic reports, the pound was among the top performers. However, the declining equity prices after the beginning of the American session weighed on sterling. The euro-sterling rebounded from the key 0.85 area back toward 0.8550, weakening further the pound. The GBP/USD could post the lowest daily close since late August under the 20-day simple moving average. The pair is breaking a consolidation range. The next support below 137.60 might be seen around September lows at 137.20 to 25. Eurodollar is attempting to correct the hourly bearish trend in late New York, running up to hourly resistance near 117.70. The pair is down 0.42%, currently at 117.66, and has fallen on the day from a high of 118.20 to a low of 117.50. The bears lost their footing on Thursday following a rally in greenback. The retail sales unexpectedly increased in August. The dollar rallied because the data has investors more optimistic about the US economic recovery that had started to look as though it was losing steam. Data has bolstered investor expectations for next week's policy meeting and how soon the US central bank will start to taper stimulus. The dollar index has hit its highest level since 27th of August at 92.866.
This is today's market news. Thanks for listening. We'll see you next time.